Hello, my name is Bob Baird. I've been in the financial services industry for over 25 years, have a background in economics from Dartmouth College, and for years I've followed a series of accurate price predictors for real estate, interest rates, and the economy in general. In the next few minutes, I'm going to give you the best information currently available to give you the confidence to take advantage of possibly the best opportunity you'll see in your lifetime. Yes, I believe the current interest rate environment, combined with the affordability index of real estate, is going to be looked at 10, 20 years from now as the good old days. So sit back for a bit and see exactly why I believe that right now is not the time to be squeamish about buying a home. The most important economic fundamental is inflation. It's the key driver of everything the Fed does. If inflation kicks up above 3.5%, the Fed goes into a tightening mode. But that's very likely a long way off. Economic growth and demand is simply too weak to establish inflation. In fact, you'll see by this chart that this data predicts a small bout of deflation in the middle of 2011. And this means that the Fed is very likely to keep rates as low as they can and keep them there. It means adjustable loans, the prime rate, and lines of credit are going to stay historically low, but they are going to go up from these levels. The biggest factor for this is the unemployment rate. It's probably going to get worse before it gets better. Now, politics could play a major role in this, but all things being equal, this model is predicting a double dip recession for 2011. Now, rather than scaring you about the possibility of a double dip, this should encourage you. Bottoms in any market occur in bad times, not good. They don't ring a bell at the bottom. All of these statistics point to lower than average mortgage yields, but if you look closely at this chart, it appears that we may have seen the bottom in rates, and that rates are generally going to move higher over the next few years. This chart speaks volumes about why this is. This is a chart of 10-year Treasury bonds, and as you can see, it goes all the way back to the Reagan years. About every 5 to 7 years, we have a bottom in interest rates. Now, right now, we're very close to the lows made in 2009. But it's probably going to usher in a period for the next few years of generally higher rates, albeit low historically. So what does this all mean for you, the home buyer? Now, this data is for the last 20 years, and houses right now, based on income, interest rates, and prices, are 50% more affordable than 20 years ago. In fact, homes were less affordable in the 1970s than they are right now. Now, home buyers are generally fixated with the price of a home, but unless you're a cash buyer, the most important factor in your decision to buy a home, other than the fact that you like the home a lot, but it's your payment, not the price. This depends on price and interest rates. In this slide, I use an exaggerated example to make a point, but you have essentially the same payment at 4.5% for a $290,000 house as you would for a $200,000 house at 8%. Which one would you rather have? Now, today, we need to look not only at price expectations for real estate, but interest rate expectations. Now, recall that we're expecting generally higher rates for the next few years. So what's this going to do to your payment? This slide shows how much it costs per $100,000 loan amount for each quarter point rise in rates. A full point higher per $100,000 loan costs you $22,000 over the life of the loan. Double that for a $200,000 loan. Now, 18 months ago, rates were in the mid-sixes. It's not at all unlikely that we could see rates approaching this level in the next few months, years, what have you. Now, here's a picture right now of what mortgage bonds look at the present time. Now, since April, we have gone from a 5.25% rate to a 4% rate at the lows, and as you can see, prices are now moving lower. Now, this isn't just going to go straight down, but it would not be at all unrealistic to expect prices to get back down to this level. So mortgage rates to around the 5.25% from about 4 3/8, 4.5, where they are now. Now, here's a realistic example of what you can expect for a home purchase. In this case, we show the likely cost of waiting in today's market. Let's take a look at what might happen for a $400,000 purchase with an FHA loan at current rates, about 4.5%, and compare that with a comparable loan if prices dropped for homes from 400 to 380, but that interest rates went back to normal, like we talked about 5.25. So even though you have a smaller loan amount here, you have a higher payment for a lower priced house. Bargain hunting can be expensive in this environment. Now, any economic forecast can go wrong, but I hope I've shown today that even if some of these predictions turn out to be incorrect, prices and rates are so good, both on a historical and immediate perspective, that you need to ask yourself a question. If you're in the market for purchasing a home, can you really afford to wait? I think not. I help people every month with making the most important financial decision of their life. Houses today are a screaming bargain. Don't wait for the crowd to get this message, and they will. But when they do, prices and rates are going to be a lot higher then. And one final comment. Your CPA helps you with your tax strategy. Your financial advisor helps you fund your retirement. Your realtor helps you with your plan in purchasing a home. A good mortgage broker helps you integrate all of this into a uniform financial plan tailor-made for you. And this is what I do. Let me help you with that process. This is Bob Baird with Disney Financial, and thanks for listening.